What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and today, for the first time in over 3 years, the Federal Reserve has finally raised rates. They've been talking about it for a long time, and they finally pulled the trigger, raising rates by 0.25%. Is this too little, too late? What impacts will this have on the market, and how far can they actually take this? Can they take it through to the finish line like they are currently planning? Ready? Let's dive in. Sometime around 6 years ago, I read a book by Jim Rickards called The Road to Ruin. In this book, Jim details a conversation that he had with old money, wealthy, rich families who had preserved their wealth for generations. In this conversation with them, he asked them, hey, what's the secret to preserving your wealth long term? How have you been able to preserve your wealth for so long? And he said their answer kind of surprised him. They invest in 3 main asset classes to preserve their wealth. Number 1, gold. Number 2, land. And number 3, art. The problem is, historically, it's been very difficult for the average investor to invest in art, mainly for 3 reasons. Number 1, most people don't know what they are looking for. Number 2, it's very difficult to tell if what you are looking at is actually real or a knockoff. And number 3, you don't know the real value of the art, whether or not you are getting a good deal or getting ripped off. But all of that is now changing with this revolutionary startup, today's sponsor, Masterworks. Masterworks is the first platform and app where you can buy shares of real art. These are not NFTs. This is physical art from legendary artists like Banksy, Picasso, and Vincent van Gogh. You can own fractional shares of these pieces of real art. You can hold on to them, you can watch them grow, or you can sell and trade them on the secondary market. There is no other platform like this, and it's starting to attract a lot of attention because art is an alternative asset class. It offers investors the chance to buy something that is uncorrelated to things like stocks and bonds, the more traditional assets. These days, with inflation increasing every single month, we are seeing the purchasing power of our dollars eroded every single day. So it's more important than ever that individuals are finally able to access investments and asset classes that used to be only available to the rich, the wealthy, the elite. But now, by doing something as simple as visiting Masterworks.io, anybody can browse art by artists like Picasso, Monet, Banksy, and Andy Warhol, and buy fractions, buy shares of these pieces of art. This way, people are able to diversify and hold partial ownership of multiple pieces of art instead of having to throw all their money in all on one. And you can trade them just like you would trade stocks. Thank you so much to Masterworks for sponsoring this video, and go check out Masterworks.io. And if you use my link in the description below, you will actually be able to skip their wait list and start diversifying immediately. All right, so the Federal Reserve raised interest rates by 0.25%. That is 25 basis points, 25 bips. Now, their plan is to continue to raising rates throughout the rest of this year and ending the year at about 1.9% with 6 rate hikes along the way. And I'm going to show you why there's a big problem with that plan and how we probably won't be able to actually make it that far. But first, they also discussed looking at shrinking their balance sheet. Their balance sheet reached almost $9 trillion at the peak. It is now moving sideways. They are not at this point on net adding anything to it or taking anything away from it. As federal government debt treasuries mature, they're automatically rolled over, so the Federal Reserve automatically lends more money to the government as soon as money is paid back to the Federal Reserve from the government to keep their balance sheet steady. They said in the coming meetings, not any guidance on whether it's the next meeting or the meeting after that, but in one of the upcoming meetings, they will decide on when to start shrinking their balance sheet and selling assets off of their balance sheet. So it looks like they plan on it, but at this point, no hard guidance or no hard plans on when to do that or how much to do that by. Now, we saw a little bit of a sell-off in the markets, especially things like gold early on in the morning, and we've seen a little bit of a sell-off, especially in gold over the last few days, in anticipation of the market basically expected that it was 100% certainty the Fed would raise rates here. And so we saw a little bit of a sell-off, and then during the speech part where he answered questions, the market started to really come back and bounced off the bottom, especially if you look at Gold bounced off the bottom here. Part of the reason for this, especially with things like stocks, is because Jerome Powell talked very confidently about the strength of the economy and said, no, it definitely can withstand, it's strong enough to withstand interest rate hikes. And so we're not worried at all about crashing the markets, crashing the economy by raising rates here. Now, a reason for that might be because it's a little too late, right? It's not that much. You're raising it by 0.25% at a time. Historically, if you look back at interest rates, the federal funds rate, the 2-year, the 10-year, we've seen interest rates much higher over the last couple of decades. But the problem is, as interest rates move down, the amount of debt in the system moves up, because if you can afford debt at 2%, you can afford twice that amount of debt at 1%. And so as interest rates start to move up, it doesn't matter the absolute level. If interest rates get up to 5% or 10%, what matters a lot is the change in interest rates, because if you're maxed out on debt at 1% and then rates go up to 1.5%, your debt service costs go up by 50%, even though it was only a small move in absolute terms. In percentage terms, that is a large move. And so the economy is very overloaded in debt. Governments are very overloaded in debt. So it's only a matter of time before this starts to cause problems. Now, on that note, let's take a look at the federal funds rate over the last 50, 60, 70 years. Take a look at this chart and you can see that ever since interest rates topped in 1980 here, we've been on a decline in interest rates. And I've plotted a line here. It almost looks like technical analysis, like a resistance line, because what you'll notice is every time interest rates start to go up, something happens at a certain point that causes things to break. The Federal Reserve then has to lower rates again. And every time they try and raise rates after they've solved that problem, they can't get up as high as they were before. And so we've seen this declining trend where you have a top get lower and lower and lower on where interest rates can hit before something breaks and the Federal Reserve has to drop rates again. If we zoom in closer to what's going on right now, we can see that very clearly we are nowhere, we are not going to be able to achieve high rates at all. We are going to hit this line very soon here. Now, I don't know why the dates are messed up at the bottom here. You can see this line is about 1 year from now. And while the Federal Reserve expects that they'll be able to raise rates 6 times and sees rates at about 1.9% by the end of the year, that puts it far past this trend line. We would have already had to be at 1.9% right now in order to still be under this trend line here. So the fact that they expect to be able to get up to 1.9% and maybe even raise rates past that, it ignores this trend line. And they're not looking at this whatsoever, but this is a long-term trend that shows, hey, there's a very high likelihood that something is going to break in the economy before we are able to get to that point. Depending on how long it takes, maybe we were able to hit 1.6, 1.5, 1.4, 1.3%, depending on how long it takes to get there. But eventually here, rates aren't going to be able to get that high for the federal funds rate before something starts to break, and they're going to have to either pause or reverse course. And this is just about 1 year away from now. This is not that long. So this perfectly corresponds with my expectations through the next year that they are going to start tightening, and at some point that's going to cause something to break, and it's going to start to cause markets or large financial institutions to become insolvent, to go bankrupt, to have issues where they need a bailout, need rates dropped back down again. Now take a look over here with me at gold and gold miners. We're going to look at gold and GDX here. GDX is a proxy of all miners here. One thing that you'll notice me talking about a lot, I've probably talked about it a lot lately, and I'll be talking about this more and more through the future, is gold and silver and miners. I think that gold and silver miners are probably the most undervalued companies in the world right now, and it's going to take a huge movement upwards before that changes. There is just so much value. They're so on sale, and they're worth a lot more than what the market thinks they're worth right now, in my opinion. And when we take a look at what gold did, it's been falling on expectations of the Federal Reserve raising rates, and the moment they actually do, it bottoms and rallies. And we see the same pattern happen over and over and over again. In 2015, from 2012 or 2013 all the way through 2015, the market was scared the Federal Reserve was going to tighten. So gold started falling. It fell and fell and fell until it had priced in the worst that the Federal Reserve could do. And on the day they actually started, That was the bottom in 2015, and gold put in a bottom there and rallied from there on. We saw the same thing happen. Gold anticipates monetary policy. And once it actually happens, it's already priced in everything that has been feared or anticipated. Then it starts to price in the next thing that might potentially happen. So we've been seeing that recently. In November, when the Federal Reserve announced that they were actually starting to reduce their balance sheet purchases, reduce their balance sheet expansion, we saw that was the day that gold put in another short-term bottom. It rallied from there. Gold had been selling off on expectations of that happening to the point where once it happened, it was already priced in, and it's been rallying since then. So the last couple of days, gold has been falling. Obviously, there was a big bubble, a big spike there from Russia and Ukraine, but it had been falling in anticipation of the Federal Reserve starting to raise rates. And now that it's happened, looks like that's been priced in, and now we are headed up even higher as it starts to price in what happens next. And so I fully anticipate that miners start to become valued appropriately over the next 5 to 10 years as the market and investors and big money realizes, hey, gold is not coming back down. If they can pull gold out of the ground at $1,100 an ounce, $1,500 an ounce, even $1,800 an ounce, that is much cheaper way to get exposure to gold than buying it outright, because you're buying the gold in the ground. It's the cheapest gold, and their profits increase at a leveraged rate, because if they are making a $300 profit per ounce right now and gold goes up by $300, well, they've doubled their profit margin. And so we just see so much potential right now in how undervalued the mining sector is, and how little money has started to pour into it because investors are scared from 10, 12 years ago when a lot of money poured in and everything crashed. And so we're seeing a lot of skepticism in mining still, a lot of value, and I'm very excited about the gains that the mining industry has moving forward. Again, as a result of the Federal Reserve trying to tighten, all that's been priced in, and it's too little too late. And by the time that it starts to crash markets, they're going to have to reverse course, and things are just going to explode in price from there. That's my expectation. Could be wrong. Not investment advice. As always, do your own research. Thank you so much for watching. You guys have a great day.